I'm going to be doing share-based payments today, bite-size. I just want to make sure we have the key aspects of share-based payments sorted. Because if the question comes up on share-based payments, there are some very simple and straightforward marks to get that if you just focus on the basics, you will absolutely pass the question. They then can throw in some extra sort of harder bits, and that sometimes is you've not remembered it or you've just get confused. And so it's really important to hold on to the basics and the straightforward bits so that you can ensure you get those marks. So that's the reason for doing today. It's share-based bite-size. So what we're going to be looking at is what are they? What can you actually buy with shares in this context? And how do you value them? And then looking at the two main types, which is to do with employee service, and then looking at 3 exam questions on how they are examined. Okay, so that's where we're going today. So share-based payments, what are they? Well, they're transactions where a company will compensate employees or suppliers, okay, which was what my quiz was about today or yesterday, by issuing its own equity instruments. So its own equity instruments are shares or options, or making cash payments based on the value of its shares. And that is normally things called share appreciation rights. So you either get a share or the option to buy a share, or you get a cash value based on what the share price is doing compared to a exercise price. All right, so it's basically the profit you could make on a share will be given to you in cash rather than be given the shares. So it's an important distinction to know, all right? So what can we buy? Well, we can buy assets. We could buy this football stadium with our own equity shares, okay? We could buy these footballers' service, okay? We could pay them in shares. That's my team, Liverpool, by the way, just in case anybody wants to know. And that's employee service. We could give them a bonus in shares, share options, or share appreciation rights. Now, there's a major distinction between these two, and I'll show you why. Well, the valuation will depend on the item or service bought. So if you're using it to pay employees, so share options, share appreciation rights, then you use the indirect method of valuation. You don't have a value for their employee service. You have a salary which you pay them, but you can't value them, these share options. So what you have to do is value the equity instrument that you're giving them or the share appreciation right that you're giving them. Now it says there, valuing the fair value of the equity instrument at the grant date. That is if you're going to be giving them an equity instrument. That's always at the grant date. But at the with share appreciation rights, which you'll see going forward, we would also value them every year end as going up because it's a cash liability. However, at the initial stage, you would therefore value them based on the equity instrument at the grant date. If it's paying a supplier, so this is buying that stadium or buying inventory, somebody who is supplying something to you, you have a fair value of the item. So therefore, you will value the item, and that is called the direct method. And so you would issue shares to that price, okay? So if that stadium, I don't know, 50 million, 100 million, and you issued shares to purchase it from the construction company, you would therefore issue those shares at 100 million. It doesn't matter what the share price is on the stock market at the time, what the fair value of the share price is. You would just issue them into share capital and share premium, however many shares you are giving them. So really focus on that. That's something that the examining team have brought out in the last tutor conference, saying that students didn't understand the difference between those 2 points. So hopefully that's clear. Have I got any understanding? Is everybody happy with that now and would be able to cope with that, I hope? Maybe put something in the chat just to let me know, or a thumbs up.
Can we talk?
Hello? Yeah, you can talk. Is that you, Hassan?
Yeah, the thing is, what confused me because of what happened in the here is saying that direct method is value of the fair value is the purchased one. So it is like whenever I'm purchasing from the things that we buy, I'm asking how much. That's why, because it's not involve any share.
Yeah. Yeah, no, you're right. So
Only,
there is a distinction, Hassan, right? This only applies with share-based payments, right? So normally you fair value the item that you give away with non-current assets. When there's exchange of assets, you fair value the item that you give away, and therefore you use that value to value what the item you're buying with. But with share-based payments, there's two ways of doing this. Again, you're fair valuing the item that you give away for employees, but if you are buying an item, then you use that. In revenue, it's also the opposite. So it's only in share-based payments, this distinction, which is why students get confused. Okay?
okay. Okay, get it, thank you.
So just to reiterate, we now have equity settled, where you issue your own equity instruments, so shares or share options to the recipient, or cash settled, where the company makes cash payments based on the value of its shares. Now, this only tends to be for employee service, okay? Obviously, because if it's the supplier, you're not going to be doing cash settled because you're going to be basically issuing those shares to them. So fair value measurement comes into every IFRS, but fair value measurement is its own part of IFRS2, so share-based payments. You don't look to IFRS 13 for this. You only look to IFRS 2 for this. So IFRS 2 says for equity settled transactions, it's often the fair value of the equity instruments at the grant date. So that would be an option pricing model, okay? An option pricing model. So there's option pricing models out there. Black and Scholes basically is one of them. They are the ones that price the grant date, the equity instrument at the grant date. And effectively, it's a really complicated formula, but it's basically probability weighted based on is it going to be exercised, what potential price of the shares are going to be at the grant when they exercise them, and what profit or effectively cost to the company that will be. And therefore, that is a complex model. So you're given that price in your exam. For cash settled transactions, the fair value is based on the value of the liability. And effectively, this would be the intrinsic value, similar to the one above, but it's the actual intrinsic value often, which will be the market price less the exercise price, which the share appreciation rights are set at. So again, it's the profit that the individual will make effectively, but they're obviously not going to get the shares in this case. They're just going to get a cash payment based on that intrinsic value. So the one above, options, is you actually get given the shares, you buy the shares at the exercise price, and then you make your profit yourself by selling them. The second one is the company gives you a cash payment based on that intrinsic value. All right. Now, the liability price will change every year end because it's a cash value that you have to pay. The one above, i.e. the equity, will never change. It's set at the grant date. And the reason is we do not remeasure equity, but we do remeasure a liability. Price, that's what we're talking about, price. So how does it work? Well, we have here an analysis of share options. If there's a vesting period, which is equal to the service period, here we've got a 4-year vesting period, okay? Remember, the fair value is determined at the grant date, and therefore we then charge that fair value over the vesting period on the options expected to vest. So we look forward to the 4-year vesting period and we come up with an estimate of who is leaving and who is going, who's staying. And we therefore will each point, year 1, year 2, year 3, year 4, make a look at the estimate of how many are going to vest. We could change that at year 1, 2, 3, and 4. Well, obviously at year 4, we base it on the actual. But also, we will then accrue 1 quarter, 2 quarters on a cumulative basis, 3 quarters, till we get to the final 4-year period. And the actual charge is then what is based on the number that vest. Now, if none of them vest, then we back out the charge, just so you're clear. If none of them vest, we will back out the charge. But if any of them vest, that reserve remains in the accounts. So we debit salary and we credit equity reserve. Okay? Are there any questions on that? So remember, once that reserve is in place, it does not get remeasured. It sticks in reserves. And even if the directors or managers do not exercise, that remains in reserves. The only thing that can happen is it gets transferred in reserves, okay, to retained earnings. So that is at the compulsion of the directors. If they don't want to exercise because the options are out the money, then the reserve just remains there, okay? But that is very different to if they don't actually vest, okay? Very different if they don't actually vest. If they don't actually vest, then there's nothing in the reserve. It all gets backed out. So hopefully that's clear. Now we've got share appreciation rights. So share appreciation rights is exactly the same, except we are now using the fair value at the year-end date. So the first time that we value them will be at year 1. When it was with the share options, we valued them at the year 0, the grant date. Okay? But we now change that in year 1 to year 2's fair value at the year end, to year 3's fair value, and to year 4 is the actual fair value that we therefore have on vesting. And the difference here now is we debit salary and we credit liability because we've got to pay out that cash. And cash is then paid out of the liability, as opposed to the shares, which they would have been issued out of the reserve, the equity reserve. Okay, are there any questions on that? Is everybody clear on those points? Okay. Right. Okay, no questions. Okay, so I've got some questions now. We're just going to go through 3 questions. So the first question here is a past exam question. In fact, they all are. Margie issued shares during the financial year. Some of those shares were subscribed for by employees who were existing shareholders, and some were issued to an entity, Grief, which owned 5% of Margie's share capital. So can I just mute everybody just to check? Yeah. Before the shares were issued, Margie offered to buy a building from Grief and agreed that the purchase price would be settled by the issue of shares. Margie requires advice about how to account for these 2 transactions. Right, so there's 2 transactions. One is issuing shares to existing shareholders. Number 2 is issuing shares to purchase a building. One of these is a share-based payment. The other one isn't. So can anybody say in the chat which one they think is a share-based payment? Hopefully it's quite clear. Brilliant. Answers coming through correct. Well done. So number 1 is simply issuing equity, raising finance. Number 2 is absolutely a share-based payment to come under IFRS2. So number 1 comes under IAS 32. Okay. some reason my things, I keep moving it. So here comes the answer. The shares issued to the employees were issued in their capacity as shareholders, not in exchange for their services. So they're not required to complete a period of service in exchange for the shares. So it's outside the scope. As regards to grief, Margie approached the company with the proposal to buy the building in exchange for shares. As such, the transaction does come under IFRS2. Grief is not an employee, so the transaction will be recorded at the value of the goods received. This means the building is recognised at fair value and equity will be credited with the same amount. So you would literally take the number of shares, the nominal value of the shares will go through share capital, and the difference between the nominal value, which will increase it to the fair value of the building, goes into share premium. Okay. The first payment is not an IFRS2 share-based payment. It's simply issuing shares. So you will issue the shares at the price which the employees paid for them, and that will go into share capital and share premium. Okay. Any questions on that one? Is that one clear?
My question is,
Hi, Jacob.
how many? Hey there. I was just wondering how many sort of marks would be attached to that, and is that part of the question, or is it a question in itself?
So that's part of the question, and
Yep.
there's 5 marks attached to this question.
5. Okay. So
I would say more though for the 5 marks. I would explain exactly what number 1 was.
Okay.
Exactly said. It was basically issuing shares to raise finance. Yeah.
Yeah. Okay. I'm with you.
Okay. Does that make sense?
It does.
Well, they're a good question. So that would, there was 5 marks going for this one. Okay. You're going to now ask me what 5 marks is for the next one, and I can't remember how many marks for this. So this one I've adapted slightly. There was a little bit extra to this question. Okay. It was asking, should it be under share-based payments or should it be under fair value? And the part of this is share-based payments has its own fair value. You do not look to IFRS 13 for share-based payments. You only look to IFRS 2 when you're valuing shares, okay, in share-based payments, okay? So that's different. You would look to IFRS 13 when valuing shares when it's for revenue and when it's for issuing shares, okay, and then fair valuing after that date. So let's have a look at this. This is just asking us for the accounting treatment of the share appreciation rights. So this is now showing you how we would account for them. So on the 1st of May, Margie granted 500 share appreciation rights to its 300 managers. All of the rights vested on the 30th of April. But they can be exercised from the 1st of May XT4 to 30th of April XT6. So everybody happy that the vesting period is 2 years. That is how long the managers have to work, complete service, to get the full rights. But they can then exercise them up to 2 years after. So the accounting is slightly different for when you're doing share options. It doesn't stop, you see, after the vesting period. We have to keep accruing up at the new fair value and exercise at the intrinsic value. So at the grant date, the value of the SAR was $10, and it was estimated that 5% of managers would leave during the vesting period. Well, the 5% is required, okay, because we need to assume that percentage, okay. The value of the SAR at $10 is not required because that's the grant price, okay, that's the grant price. We need the fair value at the year end. So we would really start with the 9 and then the 11 and then the 12, just so you're clear. So all of the managers who expected to leave employment did. So that 5% of managers did leave. And then after the vesting period is over, the 30th of April, 60 managers exercised their options. And therefore you need the intrinsic value because they don't exercise at the fair value. The fair value is the present value of the intrinsic value. The intrinsic value is the actual cash that they would get paid. So let's have a look at the accounting treatment. So until their liability is settled, the entity must remeasure the fair value of the liability at the end of each reporting period, and that includes in the exercise period, with any changes in fair value recognised in the profit or loss. So for the first 2 years, that would be the liability and expense. Note we're using the $9 at the end of XT3 because that was the fair value, and we only accrue up half because it is halfway through the vesting period. We then accrue up the full liability, but this time at 11 because the year-end fair value has changed to be $11. Then, after XT4, when the 60 managers exercise, it's paid out at the liability I've missed, at the intrinsic value, at the time being 1050. The remaining SARs are then remeasured at fair value. So we actually pay out of the liability and then we remeasure that liability based on the managers that have not exercised yet at the new fair value. So if I just go back, the new fair value will be 12. The intrinsic value is 1050. So the liability, you can see, brought down at the 1st of May was 1567. We then pay out the cash based on the 60 that left or exercised. And the bottom figure is what we calculate. So 285 minus the 60 times 500 times the new fair value. And therefore, we provide an extra 97,500 waiting for those to be exercised at the end of XT6. Okay. And so at the end of XT6, we then get them exercising and then we pay out the liability again. And if there isn't enough liability there, then we charge it again to expense. So hopefully that is quite clear. That's very different to what we're going to do in a minute to share options. Totally different. It's the price that's different. Okay. Right. Any questions on that so far? Okay. Then we got question 3. On the 1st of January, XT6, Edison implemented a share option scheme. So we're now looking at the accounting for share options. It says here each of the 200 managers was granted 10,000 share options and that they vest on the 31st of December XT8. So that is a 3-year vesting period. So the vesting is all about the fact managers have to work till that date, and they don't work to that date, they don't get them, and therefore they don't vest. So if none of the managers work to that date, which is very unusual, then none of these would vest. Okay, just to be clear. The exercise price of the options is $8.50. That's not the grant price. That's the exercise price. So that is what they have to pay the company to get the options, to get the shares. On the 1st of January, the fair value of the share option was $280. Now you can see it's very different because that's effectively the profit they're going to make. That's what we valued the cost of those share options to the company. And that is equal to what we think the fair value of the profit that they're going to make. All right. So on the 31st of December, the fair value of Edison's share was $11.50. And so therefore the intrinsic value of those options at XT7 were $3, which is the $11.50 minus the $8.50. And you can see that's different to the fair value at XT6 because we effectively have done an option pricing and come up with $280, which will be the present value of that intrinsic value. So that's how we get those values. And they're confusing you in this question by giving you the share price, the exercise price, and you just need to focus on the fair value of the option at the grant date for share options. So on the 31st of December, it's expected 90% of the share options would vest. In the year ended 31st December, though, XT6, Edison correctly recognised the share option expense of 1792 in the consolidated statement of profit and loss. So what is the accounting for 20XT7? So we have already gone 1 year into the share option scheme and come up with that expense. We're now supposed to go into the second year of the share option scheme and accrue up the extra expense required for a cumulative point of view for XT7. But they're confusing you by giving you lots of different numbers, and you've just got to focus on the numbers you need. All right? Hopefully that's clear. So when we look at the answer, so this is what's required now for this answer. You can't just do the calculation. What's the accounting? That's an F7 type answer. An SBR type answer is to explain it. So the grant of the share options is an equity settled share based payment to employees. 1 mark. This is recognised as an expense over the vesting period with a corresponding credit to a separate component of equity. You didn't have to write that. You could have said with a corresponding credit to equity reserve. The transactions measured by reference to the fair value of the share options at the grant date being the 280. I have put in there clearly not the intrinsic value of 1150 minus 850, which is 3. You could put in there you do not remeasure equity. The price is set at the grant date. Now, the number of options that will vest depends on the service condition, being a requirement that managers remain in employment until the 31st December. This is 3 years. So at each reporting date, the measurement of the transaction is updated to reflect the expected number of options that will vest. So here's now the calculation. The equity balance is going to be 3.36 million, and that is calculated by the cumulative expense being the 200 times the 10,000 times 90%, which is the expected to vest, with the 280, the fixed price. And of course, we're at the second year in the vesting period, so it's 2/3. So the cumulative expense recognised up to 20XC6 for that first year comes off, and therefore we now have an expense of 1568. You would then show the double entry, which would be debit, salary, credit, reserve. So that is important because the marks aren't just going for the calculation, the marks are also going for explaining. And the explaining marks are just as important as the calculation marks. Now, I've cut this question in half, by the way. The other part of this question was all about deferred tax on share options. And you haven't done deferred tax on share options yet. But I will come back to this question when we come to revision and go through the deferred tax aspects of it. Okay, but what I'm hoping is you've got the 3 basic types of questions shown there, which you should be able to use the figures in and stick to the rules, explaining your calculations as you go. It's an explaining exam, not just a calculation exam. Okay. Are there any questions on that one? Any burning questions? Okay. So the further complications which aren't in this bite-sized share-based payments is these. You can have performance conditions. So a market condition means based on a share price. You ignore that. Anything to do with a condition based on a share price getting to a certain value is ignored because it's already costed up in the grant price of that share option. However, non-market conditions like working for the vesting period or based on a profit target or a changing investing period based on a profit target or the number of options based on a profit target should be taken into account. And you look at it at that point in time and assess how many are going to be vesting at that point in time. That's all you need to do. Market conditions you ignore. You always write that in your answer. Anything to do with the share price is a market condition and you ignore. You could get modifications and cancellations. So modifications are repricing. And what happens there is you basically accrue up the existing scheme and then you accrue up the add-on, i.e. the repricing separately. Cancellations, you literally accrue up the existing scheme and therefore settle out of that. So you accelerate the vesting period. So if they cancel it and it was on a 3-year vesting period and you're year 2, you accelerate up to year 3, settle out of it, and then start the replacement as a new scheme. The compound/hybrid is where you have equity and liability on the same scheme. Equity and liability on the same scheme. And so that is the choice of the holder where you need to split it between the liability and the equity component. And so if you have a look at the example in my tuition notes, basically you value the equity and the liability at the grant date. You then split it liability and equity option based on the higher, which will be the equity grant. And then going forward, you treat them as 2 separate calculations, one under share-based, i.e. share equity scheme, and the other liability as a cash-based scheme. Deferred tax, we haven't done yet, but basically you're allowed a tax deduction in most jurisdictions based on the intrinsic value of the option. Okay, and so what happens is, because that is a cost to the company, if you think about it, a cost to the company is the intrinsic value. They are going to be issuing their shares at the exercise price, the option price. And therefore, the employee is getting a bonus because hopefully the exercise price is lower than the share price. And that is therefore the cost of the company because they're not getting the proceeds of those shares, the true value of those shares into their company when they issue them. And so the taxman allows them a tax deduction for the intrinsic value. And because that is going to be a future, we create a deferred tax asset for it. So that future tax deduction is accrued up earlier to match with the expense in the accounts. Remember, deferred tax, if you haven't gone through it, is all about matching the accounting to the tax implications. So the accounting transactions to the tax implications in the same period. And it reverses, hence the reason it accrues up and then it will reverse when the options are exercised. So absolutely, all those further complications are going to be in my tuition, and hopefully you've gone through those because I think they were last week. But as a reminder, the basics are the most important, and these are simply add-ons which could be in your exam questions. So we do need to be looked at, but the basics are always going to be there and get you those valuable pass marks. Okay. So I've got a question. Simply because we got that tax allowance for the period, then we defer the accounting for it. No, we haven't got a tax allowance until they are exercised. Remember, tax is cash accounting. We do accrual accounting. Okay. So because we're getting a tax allowance in 4 years when they've vested and they have been exercised, we have to accrue up the tax benefit to match with the accounting benefit. That's deferred tax. Okay. So, have we got any questions? I'm already on 40 minutes because I did say it was going to be 40 minutes. Have we got any questions or burning things we need to know? I'm going to turn off the recording in case. But let me know in the chat how you found that. Was that helpful?